Hello, students, and welcome to this mini session on pricing. Pricing is the second element and one of the most important elements of marketing mix. Pricing is the one element of the marketing mix that produces revenue or other elements in the produce cost. So normally the marketers gives high importance to the pricing comparatively other elements of the product or a service that they are marketing for. Now, the very first important concept that for understanding pricing strategy, as we are understanding marketing mix strategies, and under the marketing mix strategies, what could be the options for the pricing strategies? We can understand pricing strategy based on given metrics of quality and price, where on the y-axis we have price and x-axis we have quality. Normally, what we understood that higher the quality, higher the price, and lower the quality and lower the price. But you might find somewhere difference here and there, depending upon the competitive situation, depending upon the objective of the organization, or depending upon the leadership mindset of the organization. Now, the types of the different strategies that you can use for pricing is starting with, like, you can have a high price for the low quality product. You might find some examples where the quality of the product is relatively low and the price is very high. The major objective of it is called market skimming pricing. The major objective, or in general the objective of market skimming pricing, is that to get cash inflow in initial stage of the product life cycle and use that in the qualitative development of the product or other elements of the marketing, like setting up the supply chain and etc. etc. So if a price is set for the low quality, high price is set for the low quality product, it is called market skimming pricing. If the product is having a low quality comparatively, and the price is also low, which is economic pricing or ideal pricing, where the organization being realistic towards the market, towards the competition, towards the overall environment, and business environment, and to try to enter the market with the particular segment. The third type of pricing strategy, or third option of pricing strategy, is market penetration strategy, where high quality product you are selling for the low price. Now, definite objective of this market penetration policy, where is you are trying to convince customer to try the product. The product is giving a very high quality and relatively low price. Some author says the market penetration policy is called competitive pricing, where you are delivering very high quality product at lower price, relatively lower price. So normally many organizations use this in the introduction stage of the product life cycle. And the last is the premium pricing segment. You would have plenty of example in FMCG products and even services where the high quality product is sold at high price, like where the organization is selecting a particular HIG based on high income group or a particular specific type of target customer, and use that and attempt that with that premium quality product with premium price. Now, that's having said that, the pricing, as it is one of the most important because it generates revenue, it decides profitability of organization. So the organization has to take the pricing process is very seriously. Now, there are 6 steps of setting up a price. Very first thing is, the first step is selecting pricing objective. Now, each price, whenever organizations set a price for the product, there has to be an objective. The objective could be like maximizing current profit. Objective could be, market skimming. Objective could be uh, product quality leadership or a premium pricing, what we sell, or objective could be market penetration, etc., etc. So setting a price is like not only job of the marketing, but it is a strategic function. The marketing manager or CEO marketing can't decide price just like that. At least they have to report, or in the most of the organization, they have to get approval, where uh, as it includes the strategy of the organization, whether they want to market scheming or market penetration, or could be just survival, or to get particular amount of profit. So the top level management is always involved in pricing. So the first step was the selecting the price objective. The second phase comes determining demand. Now, once you have selected your objective, you you analyze how much demand in the target market that you have, and is that feasible? And if it is feasible, up to what is the scalability of their strategy? Now, scalability means up to what extent you can survive, or up to what time you can use a particular objective of pricing. The third step is estimating cost, most important. And most of the marketing venture fails because they failed in cost estimation. Either they failed in cost estimation or they failed in consumer mindset. Now, cost estimation is extremely important because uh, ultimately this is going to have impact on revenue. If something has direct impact on revenue, will have direct impact on pricing. So you need to know end of the day, whatever your objective is, how much you are earning, how much your profitability is, or what is your operating profit, what is your estimated net profit. And you can't have that unless until you estimate the cost. So the step three was estimating cost. The fourth step is you do competitive analysis, where you analyze competitors' cost, direct competitors and indirect competitors. Then what is their cost? What is their prices? What are their offers? What are their marketing tasks? Or uh, what what are they doing for the marketing promotions? Now, the direct competitors is quite very straight and easy, but indirect competitors analysis is really complicated. Now, direct competitor, for example, you are producing hatchback car, so the other companies producing hatchback car are your direct competitors. But then other companies are producing sedan also, and some companies are producing SUVs also, and many companies are producing everything. So then, uh, uh, the producers and sellers of sedan and SUVs and sports car and etc. hybrid car and this car and that car, these are your indirect competitors. And what are their price range? You need to be like competitive. Here, when you analyze the competitive environment for your product or services, it's extremely important for you to analyze what market set you are belonging, whether it is monopoly, oligopoly, or a monopolistic competition, or if it is a homogeneous product, for example, rice. You can't fix the price of rice like in general, like something little bit here and there, but rice is homogeneous product. Rice is produced everywhere or most of the places. And then where the rice is not produced, there are they can get supply from rest of the places. So it's an homogeneous product. So market decide the price. There you have to fit your cost with the market price. If the 5 kg rice, for example, the cost is $20, the market price is $20, around $20. So you can have 21, you can have 18, 19. But it would be next to impossible for you to set up at 15, and it would be very much challenging if you put it 25, because there are marginal product differentiation. There could be, the size of the particular grain and all. You can use it, but then how much it can be impactful, that is also a question mark. Very, very negligible impact. And like end of the quarter, you have come to with the promotion if you want to have a stock turnover. So, which market you are dealing in, like whether the market is monopoly or monopolistic competition or oligopoly or homogeneous market, that that have a impact on your competitive analysis, which will have a direct impact on your pricing strategy, setting up your price, and even establishing pricing objective. The fifth step is selecting the right pricing method. Now, how you want to select the price? There are some organizations, they just do markups like 10% on the cost or 20% on the sales should be your 20% profit that you expect on your selling price, or 10% profit on your cost price you are expecting, which is called markup. Or a target return price, like you need $10,000 per day or per month as a profit, and you select price accordingly. Perceived value pricing, where you forget about cost, but then how much that has value in the market, and based on that you select the pricing. For example, like 2 years back when corona's first layer was there, and uh, the price of sanitizer was sky high because the demand went sky high. So at a time, perceived value, that small bottle of like 20 ml and 15 ml was selling for $15. So then you can have a value pricing, like, high price, high quality, high price, low quality, low price, value pricing. Or going rate pricing, you just take a price from the market, which is a competitive pricing. Then you might have an auction type pricing, where you are dealing with the industrial B2B, that you are dealing with industrial customers. Then you can have an auction type. You put an auction like who can supply you, or who, and then you set up the price accordingly. And the final step, after this, all five steps, all this analysis you are done with, and you are strong, and then with the concept or with the strategy that you are dealing with, then you select the final price. Uh, I hope this mini session on pricing will be helpful to you in your understanding of the marketing mix, a very important element of marketing mix. Thank you.